One of the most important factors that you need to be aware of when you're making career decisions early on is how much that job is going to specialize you. Depending on the kind of analysis, the kind of deals, and the kind of work you do at your job can really impact the kind of opportunities you'll get from recruiters. Honestly, there are certain industries, certain kinds of analysis that you just get used to doing that are going to pigeonhole you into specific verticals. And that's not necessarily a bad thing. If you specialize your career into something that you really like and that you're very good at, then you can get looks from headhunters and from firms that other people wouldn't even dream of. So in this video, we're going to talk about the tension between optionality and specialization, as well as the factors that you should be thinking about when you're deciding. I think most people in finance, especially in university, tend to be drawn towards optionality. And honestly, I was too. It makes a lot of sense if you haven't had a lot of real world experience, if you've never had an internship in a specific industry, it can be difficult to dedicate yourself to something that feels very esoteric. And this doesn't just apply to industry groups. Private equity, for example, is an incredibly popular career choice because it kind of leaves all your doors open, meaning you don't have to make an actual decision of what you want to do. Because you could go to a hedge fund or venture capital, corporate development, you just have a lot more options. If you contrast that to going to, say, a quant fund, then you might only get quant-related opportunities after going there. One really important distinction, I think, is the kind of function you'll be doing at your job. If you're acting more in an agent capacity, like in banking or consulting or accounting, then industry matters a little bit less. But as soon as you start investing, as soon as you start deploying dollars, there's a certain amount of industry specialization that's just gonna help you. A lot of money managers stick to the industry that they know really well, because that's the most reliable way to make money consistently. So thinking about specialization specifically, I would say that it's easier to recruit for buy-side opportunities if you've picked a more difficult and narrow industry group. The thing, of course, is that it's harder to switch. Let's take natural resources, for example, because you have to deal with very specific commodities and the modeling is pretty unique. If you do oil and gas IB, like if you went to Houston or Calgary, you'll get a lot more opportunities in the oil and gas investment space. However, it might be harder to switch to other industries after you've broken into that space, so there is a little bit of a trade-off. It might be easier breaking into the buy side, but comparatively harder trying to switch to other industries. And that's because some industries have very bespoke analysis. They have very specific business models that take a long time to understand. So by the time you get to the mid-level, a lot of these people don't want to be constantly training new employees all the time. And there's going to be a certain expectation that you just know this stuff. So recruiters know that, and in turn, for these kinds of more difficult industries, they'll only hire people with direct experience. For investment banking specifically, I'll note that the group that you have doesn't funnel you that much. I think your deal experience and the reputation of the group matters a lot more than the specific industry you're in. You can be in a totally different industry group, but still get really high quality looks. Again, the most important thing is doing deals. It's much better to do deals for an industry that you're not totally excited about than be in an industry group that you really like but doesn't actually do any deals. Because you're functioning as an agent, it's a lot more important to get the execution right, to learn the ropes, and to just get the basics and fundamentals fully understood. So now I'm going to try to lay out the industry groups that leave the most options open to funneling you the most. And unsurprisingly, if you go to a generalist program, then you probably have the most options possible. Generalist means that you get to work with different groups and even different functions, and you're kind of like a rotational analyst within a bank. I'll caveat that by saying I've noticed in generalist teams that you tend to keep working with the same groups of people over and over again, so you might not get as diverse of an experience. And another thing is that groups are not all made the same. Some groups might not have great deal flow, but you'll be forced to work with them because of the generalist nature of your program. The next industry groups I would say are TMT, which is tech, media, and telecom, as well as consumer and industrials. These business models tend to be a little bit more easy to understand on a relative basis. They often sell a product or a service, and they touch many different disciplines. For example, there's a lot of tech healthcare businesses or tech financials or industrial healthcare, so you get flavors for different adjacent markets as well. And TMT, I think, tends to be the most popular, but that's because I think it's very consumer facing. A lot of the coolest brands in the market right now are tech companies, and they're carrying a big portion of the S&P and the public markets. Additionally, a lot of the top private equity firms focus on TMT. So if you want to go to where the money has been over the last decade or two, it makes a lot of sense to create a career around tech. Now, moving down the spectrum, I would put healthcare and financials sort of in the middle. I think the analysis you do tends to get a little bit more specific and the business models become kind of exotic, but it's such a large portion of the industry and a lot of high quality investment banking deals are done in these groups that they still place really well and that you shouldn't be afraid of going to them. If you're doing healthcare IV, for example, you're still gonna get looks from other industries and all kinds of investment managers as long as your firm is good. On the end of the spectrum, I put natural resources, real estate, and infrastructure. These are the categories in which the modeling starts to become extremely different. You get exposure to completely different asset classes, and the investment managers are sometimes specifically focused on that industry. There's a lot of infrastructure specific investors as well as real estate, and some of the fundamentals are just going to be slightly different. Now, with all that being said, I think there's other characteristics of your group that tend to be more important. And as I've alluded to, I think the most important thing is to make sure that you're actually doing deals. So keep that in mind when you're looking at industry groups. And the best way to do this is honestly to check bank websites and just see the deals that they've done recently. Which industry are they in? And that should frame your opinion of what you want to do. Secondly, and I do this with every job offer that I've thought about, is to look at the specific exits over the last 5 years of that particular group. I think 5 years is a good enough time where you kind of get rid of the noise and you have a large enough sample size. It's sometimes hard to tell until you're in the group, but some groups just place better than others. Sometimes it's because partners are really helpful or there's a culture of recruiting. All these kind of things are hard to tell from the outside, but at the very least, you can observe the data of which groups are doing better. Now, the most important thing when you're doing banking consulting is to make sure that you become pretty good at modeling and you understand what you need to do technically. And if you've had these experiences, it'll matter a lot less which industry group you'll have been in because you'll have such a good diversity of projects. I think it's really important that you've built at least one operating model because that gives you a sense for the 3 statements as well as building things from the ground up and using a units-based calculation. And it'll just really set you up well for investment modeling down the road. And I also think it's really important to try to do at least one buy side and one sell side so you have a good understanding for the entire financial ecosystem. And lastly, if you can help it, I think it's very helpful to have at least one mentor. That should be your goal. One associate or VP, someone that you trust and has similar values to you that can sort of guide you through your career. And if you have all that, it really doesn't matter which industry group you picked because you'll have a well-rounded experience. I think it's also really important to understand that this changes throughout your career. If you observe the VPs in your investment banking group, you'll see that a lot of them are angling for different industries or different verticals because that's the point when you really have to pick. It's hard to really understand the nuances of a particular deal unless you've worked in the industry for a long time and you've really devoted yourself to it. At the analyst and associate level, a lot of your work is more technical and doing more execution-oriented stuff. But past that stage, you have to think about the business strategy. You need to know specific people in the industry and you got to go to conferences and just do the whole show and tell. And that takes a lot of work and it's hard to spread yourself so thin across multiple industries. I think what's also interesting is that when you get past that level, you're kind of paid to think more like a generalist again. If you're an asset manager, you have to be aware of the different industries and the different sectors beneath you, and that requires a little bit more of a generalist toolkit. But at the junior and mid-level, I think it can really help a lot to lean into whatever industry preferences that you might have. If you can go to the headhunters and brand yourself as a very specific kind of person who likes only this kind of industry or this particular kind of investing, then that specificity will help you get those particular opportunities. Now, me personally, I've done TMT at pretty much every job I've had in both private equity and investment banking. And I would say that's born out of both a personal interest and me understanding that it kind of keeps my options open. I've seen a lot of people move from TMT into other fields, and I understand that it's a good place to grow your career. So in conclusion, I think the faster that you can understand your preferences, the better, and you should pursue them as soon as possible. But if you're still not sure, then just make sure you're getting that good technical experience. Thank you so much for watching this video. As always, you can check peakframeworks.com to check out our finance career courses. And I'm pretty excited because we just launched our brand new redesigned website. It looks a little bit sleeker and more modern, so hopefully you can check that out. Please remember to subscribe, and I'll see you in the next video.